Hello, everyone. Welcome to the Main Street Money Podcast, where Wall Street meets Main Street. I'm Andrew Gay, along with Gilbert Pies and Zachary Green, and we are the Texas Hill Country Advisors, based in Kerrville, Texas, here to bring you the latest in markets and from wealth management. So let's jump right to it. This was one of the most consequential weeks of 2026 so far. We got a lot of stuff going on, don't we?
Oh, yeah.
The Fed held rates steady. That was widely expected. Revised inflation higher, and the S&P 500 broke below a key technical level for the first time in nearly a year. That is the 200-day moving average. We're going to talk about that a little bit too here in just a minute. Oil hit $110 intraday. Gold finishing out this week with the worst week since 1983. The Iran conflict continues to escalate. So we're going to break all of it down, what it means, what it doesn't mean, and what you should be thinking about as an investor after this week. So let's start with the Fed. Hawkish hold and a dose of reality from the Fed this week. So the Fed had their meeting. They were widely expected. It's a 2-day meeting. They finish on Wednesday. They come out and do a press conference about 30 minutes after they conclude their meeting. It's highly anticipated. It always is. Jerome Powell comes out and does this press conference 30 minutes after the meeting. So you have reporters and all the media personnel in there trying to pick apart what he's saying and look for little hidden clues in the language about their adjustment to the language for the Fed meeting minutes, which actually comes out a little later. But really, they're looking for their guidance moving forward and what is their expectation about interest rates, inflation, growth in the labor market. So the Fed voted 11-1 to hold rates at their current level, which is 3.5 to 3.75% on Wednesday. There was no surprise there whatsoever. It was widely expected that that's what was going to happen. But oddly enough, I would say what was not expected to happen this week, kind of related to the Fed, is the movement in interest rate expectations after all the stuff with oil, the price spike there, and the expectation that that's probably going to move inflation, at least the headline number of inflation around. The core number of inflation doesn't really use the commodity type goods that the headline number has in there. So, but either way, it's still going to move headline inflation. Expectations for interest rates moved off of that, with now the market's only expecting about one rate cut between now and in the end of the year, and not even highly convicted that we're going to see that. The Dow initially fell 768 points Wednesday after the Fed meeting. Is his worst single session in 2026 so far. And Powell acknowledged the Middle East conflict as a complicating factor for the dual mandate, which is inflation at 2% and employment at full employment, which is roughly about 4%.
He basically said, my hair's on fire and I don't know what to do.
But I'm going to remain calm.
But I'm going to remain calm, exactly.
And try to have a common sense, logical reaction to all of it. So.
Yes, and I would say too that even if he did say my hair's on fire, I'm going to remain calm. That's probably the key takeaway. Remain calm. This is certainly a volatile time period for the market, but it's not unprecedented.
Yeah, and it doesn't. And just because the Fed's probably going to not cut rates as quickly as we had previously thought, and we're not really sure what's going to happen with the labor market. The Fed's not either, whether or not that's going to loosen. So are we going to see weakening growth with a backdrop of higher or stickier inflation this year? We don't know, but it doesn't necessarily mean it's a good reason for you to change your long-term plan or strategy.
Because I would say this too, there's a lot of pressure on the administration to conclude this war quickly. They are focused on trying to get something done before the midterms. Midterms are in November. It's going to be a very important election. There's been a lot of retirements in Congress. And if the Republicans want to control Congress, the House and the Senate, they are going to have to convince people, independents and other Republicans, to come out and vote for them. And if they don't conclude things by that time, there's probably not going to be a lot of really strong feelings in support of Republicans, especially if oil prices remain elevated, gas prices remain elevated, inflation is taking off again. That is not going to inspire a lot of people to come out and vote Republican in the midterms. And I think it's pretty easy to say that the Republicans want to maintain control, because we know what happens if Trump stays in office for another 2 years, which of course he has to be, unless, well, I won't go that route, how he gets removed before then. If Trump stays in office and the Democrats control the House or the Senate, nothing's going to happen over the next 2 years, the last 2 years of the president's term. And I think it's fair to say that Trump really has an agenda that he hasn't finished completing yet. And he knows that if he doesn't win Congress in December in the midterms, that the last 2 years of his presidency are going to be a whole bunch of nothing.
Yeah. Let's move on to some price action in the S&P 500. The S&P 500 broke its 200-day moving average, which it sat around 6619. So 6,619 was the level. The S&P closed at 6606. So a little bit of context there. If you don't know what a 200 moving day average is, let me read you the definition.
Wait.
Yeah.
6506.
Oh, 6506.
Yeah, we were
sorry.
off by 100.
Yeah. Thank you for catching that.
Worse.
Yes.
Yeah.
So so the 200-day moving average is the average closing price of the index over the last 200 trading days, so roughly 10 months. When the price is above it, the trend is considered bullish. Institutions are typically buyers. When the price breaks below it, which it just did, trend signals flip to negative. Algorithmic systems often begin selling, so they automatic either stop losses or other algorithmic trading kicks in, and it is a self-fulfilling signal to a degree, which means enough people watch it that the break itself causes more selling, and that can be a common theme in markets,
which usually means things are going to get worse before they get better.
Right. So historical context, the S&P 500 has broken its 200-day moving average many times and recovered every single time. We kind of know that's not a secret. 2018, the break lasted weeks. It recovered quickly. 2022, the break lasted 7 months. That was a painful one. That was long, but it still recovered. And then 2020, the COVID break lasted 2 months. Sharpest recovery in history, which was like, because that first few months of 2020 were rough for equity markets.
That was a V-shaped market.
Yes. And we're currently in a K-shaped type of economy right now. So we got the alphabet soup going on.
Have you heard about the E-shaped recovery or E-shaped economy?
No.
We'll cover that next time maybe, but yes, I've heard about E-shaped recovery.
That's interesting.
Yes.
So the Dow broke below its 200. We were just talking about the S&P. The Dow broke below its 200 moving day average on Wednesday for the first time since June of 2025. In general, the 200-day moving average is a technical signal that can trigger institutional algorithmic buying and selling when it's touched or broken. What it does not mean, I think that's important that we cover that too. What it does not mean is a guaranteed recession signal or market crash trigger on its own. 2022 had a prolonged stay below the 200-day moving average. It took about 7 months to recover. We just mentioned that. 2018 broke below briefly and recovered within weeks. Context and fundamentals still matter. It's just a warning flag, not a death sentence. So some technical movements going on there in the equity market. Did you have something you want to add to that?
Yeah, I was just going to say, we've gotten a lot of questions this week, especially this week, from clients and prospects and other people we talk to. What should I do? What should I do? And I think the thing to do is nothing.
I just got off the phone with someone asking that question. It's like, Do we
Well,
need to do anything? And the
what
answer
should
was
we do?
no.
Yeah, I think the answer is no. If you're properly allocated before all this happened and nothing has changed really with your situation, you haven't retired, lost your job, got married, had children, got divorced, had a parent or a child suffer some disability. If none of those things has really changed for you, then probably you should do nothing and continue doing what you're doing. In fact, I would also say to most people that if things have not changed for you and the market goes down, it's a great opportunity to step into the market, because I think it's fair. Most of us would say at this table anyway that the market was pretty overvalued for a little while. The PE ratios were extreme. Valuations had got out of whack. Growth stocks were the Mag 7 last year, especially, did fantastic. There was extreme extreme movements in price for just a few companies, and that had to work itself out. And I think this is a fine opportunity for some of those valuations to come back down. And if you're able to, it might be a good time to step into the market over the next couple of weeks, couple of months, maybe even 6 months, depending on how some of these things work out in the headlines.
Yeah, and I think there's always opportunity out there, and but like we were talking before we started this, it's just a matter of where and what kind of allocation would make sense for you based on your goals and your situation. But one thing that I think was not expected this week, as far as price action movements go, was the 10-year going up to like 4.3. I don't think anybody expected that. We know that expectations for inflation were kind of moving back up with the price spike in oil, but that's a huge move. I think it was up 2.5% just for today, which is a really big move for the 10-year U.S. Treasury.
And that's telling you, I think, that the bond market believes inflation, at least in the short to intermediate term, is going to be going higher. And that's probably not a real hard calculation to make,
Right.
considering the price of oil over the past few weeks and the potential for it to stay elevated. I think it also signals, and I'll throw this out there, that we might even get a rate increase if inflation becomes a problem later during the summer.
And for the first time this week, there was the probability for a rate increase on the board from the CME Group Fed Watch tool.
I knew it was a matter of time, right?
Yeah.
Yes.
I think it's important to know whenever you're saying, oh, rates are high, rates need to get cut. That's something I was kind of saying to myself whenever I first started. I'm only here for about a year, so I had a lot of learning to do. But historically, we are still at a pretty low rate environment right now.
Yes.
It's not awesome having 3.75. It would be great to go down to 0.1 again or whatever, go to almost zero. But this is pretty below average historically, and it's not the end of the world if rates don't get a cut this year, despite what Trump may make it sound like.
Yeah, and I think it's still accommodative for a lot of people.
Sure, and you're right, Zach. You have to look at the context. When we were in the rate environment where interest rates were extremely low, they were extremely low for a reason, because the economy was in the toilet. That was right after the 2008, 2009 financial crisis. We don't want to go back there. We do not want to go back there to where the Fed feels like they have to drop rates to practically zero,
Right.
to motivate the economy. We do not want that. That is a horrible, horrible thing. I still have nightmares about 2008, 2009, the financial crisis. We do not want that. So, do we want interest rates to be higher than zero? Absolutely. Do we want them to be 9%? No. Somewhere in between would be really, really nice. And the historic average has been, I think, about 4.5.
I was about to say it's got to be 4 to 5. It's got to be above where we're at now.
For sure. So, could we stand another rate cut or two? Maybe, but that's going to be impossible for the Fed to do if inflation keeps being stubborn.
Right. And speaking of inflation, that's a great segue into our next final 2 points. But one is the continued Iran conflict that's going on over there and the Strait of Hormuz, which has impacted the supply of oil. So a couple of things happened this week. There were some more attacks on oil infrastructure over there, back and forth. And I think that it kind of opened the door for Iran to think that initially they were saying they weren't going to attack that kind of infrastructure and those types of projects with drones and whatever else. But this week, I think they have blown past that, and it is official that those attacks are happening. But what is not confirmed is how that's going to impact the continued stress that's being put on the oil supply that's out there in the global market. It was Qatar's largest gas field and Kuwait refineries were the ones that were struck this week.
Yes. The largest liquefied natural gas field in the world. I think you told me that earlier in the week, and it is.
That's right.
The largest. So it's not great that both sides are seemingly willing to strike economic pillars. Striking people isn't good either, but economically not looking good so far.
Yeah, and I think that's just going to continue to put stress on global markets as far as oil and whatnot. I don't think it's is going to end as quick as most people think or wanted it to. So at least that's how markets are currently pricing it. I think the crude futures for December we're not above where the price of oil is currently at, but they're still very elevated. I think the last time I checked, they were still closer to $100 a barrel, which means markets are pricing in a continuation of all of this conflict. Otherwise, you would see those contracts priced closer to like maybe $50 or $60 a barrel, not 90 or 100 if the markets were thinking that this was going to end in the next couple of months. And then last talking point today is gold. We love talking about gold, but it had its worst week since 1983. So it was down about 10% on the week. Worst performance since February of 1983. It fell from about 5,000 to 4,500 intraday. Silver's down more than 10%, worst week since January. Counterintuitive, giving stagflation fears driven by rising real yields and dollar strength. We have not mentioned that word today yet, but that is one of the ways to describe the economic situation that we're in right now, and kind of what fear, because there's always fear out there, right, from uncertainty and whatnot in financial markets, but that's really what's driving most of that, is stagflation and the idea that we might have softer growth and elevated inflation, which is not a good economic environment to be in.
That's putting it mildly. It's actually the Fed's ultimate nightmare,
because they don't have tools to fight it.
That's right.
Right.
That's right. Well, they're forced to make a decision about what's more important.
Yeah, growth or inflation.
Exactly.
And labor market, right?
And there's not a whole lot they can do to force companies to hire people. So what are they left with? Fighting inflation. So if you think the Feds won't raise interest rates to kill off inflation, you're wrong. They will do it. They've done it before. They've done it in the past. And it's the lesser of two evils, because they can't actually force companies to hire people, even if they drop rates, which is why 2008, 2009 financial crisis was so tough. Even though rates were at zero, it wasn't that borrowing costs were too high, that companies were afraid to expand. Companies were afraid. Companies were afraid to do anything. So the best option they had was to do nothing. And that's a problem. So they couldn't hire people because they were afraid. Didn't matter how low rates were. But the opposite is true too. If the Feds think that inflation's too high, they will raise interest rates to kill it off. Think of the 70s and 80s. Now, I had a customer this past week tell me that he thought what we're going through now is very reminiscent of the 70s and 80s. Oil embargo, high interest rates. That was a really tough time for our country. Now, you two don't know that, don't remember those because y'all weren't born yet, but I was born, and I was a little kid, but I remember the stories and remember all the people that lived through that time period tell me how tough things were. And I think that the feds really would do it again if they had to. It's not going to be pretty, it's not going to be nice, but they'll do it again if they have to, because they have to figure out a way to get out of that stagflationary spiral. And one of
Yeah.
the only ways to do that is by raising interest rates. That's not what the Fed wants to do. It's not what the administration wants. And frankly, I don't think that's what any of us
I don't
want.
think the consumers want that either. That means
Mm.
higher mortgage rates,
Yes, higher
just
credit card
higher
rates.
borrowing costs across the board.
For
Yeah.
sure. Now, if you're a saver and an investor, hey, higher interest rates are good. But-
Inflation's a good thing, right?
Well, it can be, but what I think a lot of people forget when they talk about how great it was to have interest rates or CD rates at 15% or 18% or whatever the number was. The economy was terrible, 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 terrible. You really don't want that either. So
Yeah.
again, you don't really want the extremes on either end. You want something that's just right in the middle, not too high growth, not too high inflation, something that is manageable one way or the other, because that's really what gets us going forward. The extremes, they're no good.
Goldilocks. That's what you want.
Hey,
You
there you
want the
go,
porridge
Goldilocks.
just
That's
right.
right.
Just right.
I was watching Puss in Boots last night. Have you seen that?
No.
It's got a Goldilocks character in there, and the three bears are like her family.
Oh,
What is it?
yes. I have.
It's the one with the wolf that
Yeah.
whistled. I can't whistle, but
Yeah.
yeah. I was watching it yesterday.
That's
That's why you
great.
brought it up.
I haven't seen that in a long time. I have to
Pretty
watch
good.
that again.
All right. Let's talk about
Um,
some winners and some losers. Did you want to add something? What were you going to say?
I wanted to ask y'all something.
Yes.
So I think there's unemployment and inflation that the Fed worries about, and most people see the rate as the only lever they have, but
Right.
reserve requirements are also a part of that as well, right?
Yes.
And that plays into that game. I was wondering if y'all saw a report this week that the U.S. is proposing maybe lowering those reserve requirements, and what kind of implication you think that would have.
I saw that over.
I mean, I would
this
say
week.
the first thing about that is I would say you have to remember the two different scenarios that we live in, or that have been around, at least in my lifetime, for the Federal Reserve. They were in what was called a scarce reserve requirement back in like the 70s and 80s, when the notorious story of Paul Volcker raising interest rates to a really high level to kill off inflation from the period you were just mentioning, Gilbert.
Mhm.
And then eventually after 08, they switched to what's called an abundant reserve requirement. And the difference between the two is the scarce reserve requirement, the previous requirement they had for reserves, was an actual free market system. So when Paul Volcker went to go tweak or mess with interest rates to try to cool off inflation, he didn't mess with interest rates at all. The reserves themselves dictated the interest rate, or the overnight interest rate, between these institutions lending themselves money. Okay. And so, in other words, what Paul Volcker did to cool off inflation back in the 70s and 80s is adjust the reserve requirement and then let interest rates go where they may. And that's exactly what happened. They skyrocketed overnight, ultimately cooled off inflation. The rest is history. But currently, they're in an abundant reserve environment, and that's described as being where the reserves are literally abundant. So there is a reserve requirement that the lending institutions and banks have to meet, and then the Fed actually sets the interest rate, as opposed to letting the overnight lending market itself dictate that rate. They literally set the interest rate. So for one angle of that is to say that it could affect the money supply, because that's really what we're talking about is the money supply, and the Fed balance sheet needs to be mentioned in that same breath too. But I don't think that it would affect the economy the same way that it would if we were in a scarce reserve environment, because right now the Fed dictates all that. So I don't see that as being something that would have a huge outsized impact on the economy. But I think if the Fed did something specific with their balance sheet, like rapidly took more money out of the money supply, which they have been doing for the last 2 years. And they just announced that they were going to stop that, which is quantitative tightening. That has a net negative effect on the money supply, and that definitely affects the economy. So this is a very long-winded answer, but I don't think that would have as much of an impact as it would had it been in a different time period.
Mm-hmm.
Good point. I'm not sure how their reserve requirements would really affect the market. I don't think I read enough about that to be sure, but in my mind, as a taxpayer, a investor, as a citizen of this country, it would seem to me that in times of crisis, you would want your financial institutions to have a pretty good buffer. In other words, a substantial reserve requirement to weather any storms that might come around. That of course doesn't just happen in a vacuum. There's some other ancillary effects after that. So I would want to know, or at least understand a little better about what reducing those reserve requirements could potentially do to the economy and, as you say, Andrew, the money supply, before I would be comfortable making a decision one way or the other about whether they should keep them where they're at or reduce them. I think from a bank standpoint, they would probably be okay with lower reserve requirements, because then they could turn around and lend that money out potentially, or invest that
I was
money.
going to say invest it, whatever they do with it.
Whatever they're going to do with it. If they can't lend it out, they invest it. Of course, they don't just leave it sitting around. So I think as a bank, if I was the head of a bank, I would probably say, yeah, lower requirements. But nothing happens in the financial world without a equal and opposite effect happening somewhere else.
Mm-hmm.
And you have to understand what that is. At least I would want to understand what that is before I was comfortable one way or the other. I'll say another thing about what I was mentioning just a little earlier. That same client that was talking about the 70s and 80s, he thought it was reminiscent what we're going through now. This is not the 70s and 80s. The United States back in the 70s and 80s was a net importer of energy. Now we're a net exporter of energy. Right. Who this hurts right now, higher oil prices, is not only hurting us, individual Americans, but it's really hurting our Asian and European friends the most, because our Asian friends, Japanese, South Koreans, even the Chinese for that matter, they're going to have to pay more for oil. It's going to affect the Indians. They're the ones that get most of their oil from the Middle East. Our European friends, right, if we can still call them that, they are the ones that are going to pay more for energy, substantially more, because, Zach, you and I were talking earlier, there are some oil contracts within the Middle Eastern market that are substantially higher than what we're seeing now in the benchmark indexes. And that could be a serious problem for those people. Now, does that mean that we shouldn't really we shouldn't really care about what's happening over there? No, absolutely not, because eventually the higher prices they're paying will bleed through the rest of the market as existing supplies get used up. Mm-hmm. But this is still not the 70s or 80s. Still a problem, it's just not the same thing. We're much less dependent on foreign oil. Our economy is much more focused on ideas and preserving or sustainability, and maybe electric vehicles like we didn't have back then. So we're not as big a industrial powerhouse as we were back in the 70s and 80s, where we have to figure out a way to continue the manufacturing boom with higher oil prices. We don't have that problem because we've exported most of our manufacturing overseas.
Right.
They're the ones that got to worry about it the most.
Good question.
Yeah.
All right, let's do winners and losers, and then we'll wrap the show. Winners this week: energy across the board. LNG names were up anywhere from 20 to 37% this week. Dell was up 5.7%, FedEx 10% on raised guidance. ARM, European chip designer, was up 4% on HSBC upgrade. Banks inching higher on potential capital requirement reductions. That was your comment. Losers this week: Super Microcomputer. Almost said Super Mario Brothers. That's what my brain was trying to do when I was
Did you
reading
see
it.
that? Did you see that article about Super Micro?
No, it was down 27% after the CEO was charged with smuggling NVIDIA chips to China.
Crazy.
Interesting.
Not a smart business move.
No, horrible.
Vistra was down 6.4%. Mosaic down 6%. Most Mag 7 names were in the red, led by Amazon, Apple, Microsoft, each down 1% plus this week. A couple of key takeaways for investors this week. S&P 500 breaking a key technical level is worth paying attention to, but it's not a signal to sell everything or freak out. It's a moment to take a breath, review where you stand. Come talk to one of us if you need a second opinion about your allocation. Make sure your investments reflect your actual goals and timeline. Fed's in a tough spot right now. Not to beat a dead horse, but we've talked about that multiple times already today. Inflation's rising while growth is slowing. That is the dirty word stagflation. That's what that's known as economically. Gold having its worst week since 1983 feels alarming, but it's explainable. You can explain that away. We've seen such a huge run up. It had like a 72% run up last year, calendar year. It's not surprising to think that that's going to pull back some, especially when you're talking about a commodity that doesn't have any cash flow or profits associated with it. It is just a tangible item. It doesn't have, it's not a living, breathing business or anything like that. Energy, one area that tends to benefit when oil prices rise, right? We all know that. We've seen some of those names move this week: Chevron, Exxon, Valero. Even if you have some exposure there, that part of your portfolio is likely working in your favor right now. And I just had that piece of conversation with someone too, that there was indirect exposure in their diversified portfolio through mining stocks or even other ETFs that have direct or indirect exposure to commodities. 4 down weeks in a row feels bad. It's uncomfortable, but history shows that after stretches like this, markets have tended to recover meaningfully within a few months. Investors who tend to do worse are the ones who make big moves based on short-term fear. So
Don't do it.
don't do it, or
Sell
come talk to
everything.
us before you actually make the move.
Yes.
And with that, we'll call it a day, call it a week. Thank you guys for tuning in. Don't forget, interact with us, share our content, helps other people find the show. We're on Facebook, LinkedIn, and YouTube. Have a good weekend. We'll see you next time. This is offered through LPL, a registered investment advisor, member FINRA SIPC. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision.